Welcome to your weekly market recap. Everything that moved the markets this week in one place. Stocks, the economy, bonds, crypto, commodities, and metals, it's all right here in one spot. In the next few minutes, you'll get everything that mattered this week, explained clearly and connected into why it all happened. First up, the Dow cratered on Wednesday for its worst single day in over a year, and I'll show you exactly what set it off. Then Meta plunged the moment its earnings hit the wire, and the reason isn't the one most people assume. And oil? It went nowhere for days, then spiked hard in a single session. What flipped it? That's coming up. I'll break down all three and what each could mean for where the market goes next.
All right, let's start with the big picture, because this was a week of pure whiplash. 3 completely different moods packed into 5 trading days. Stocks came into the week still trying to dig out of a hole, coming off 2 straight losing weeks. And for the first couple of sessions, you had a split-screen market. The Dow was climbing while the Nasdaq kept sliding, a 5th and then a 6th straight down session for the chip-heavy side of the market. That's the kind of divergence that tells you something structural is going on underneath the surface. And what was going on was a rotation, money moving hard from one part of the market to another. It was flowing out of chip makers and AI infrastructure names and straight into industrials, healthcare, and consumer staples. You could see it in the leaders. Dow names like Sherwin-Williams, IBM, and Salesforce were rallying, along with a whole list of value and staples names. Coca-Cola, Boeing, Amgen, many of them up 5% or more. Meanwhile, the semiconductor index fell for a 4th straight session. That's a classic defensive shift. Investors trimming the high-flying growth trade for steadier, cash-generating businesses. And it set the tone for the first half of the week. Then came Wednesday, and the whole mood flipped from cautious to outright fearful. The Dow plunged over 1,100 points, about 2.2%, its worst single day since April of last year. That's not a normal Wednesday. I'll get into exactly why in the bond section in a minute, because this one has the Federal Reserve's fingerprints all over it. But the damage spread. The Nasdaq briefly dipped into correction territory, more than 10% below its recent high, as the chip sell-off deepened and the semiconductor index dropped around 6% intraday at its worst. For a few hours there, the AI trade looked like it was genuinely breaking. You could see the fear in the volatility gauge, too. Wall Street's so-called fear index spiked on Wednesday, before retreating later in the week. When that jumps, it means traders are suddenly paying up for protection. That's a fear signal, plain and simple.
But here's where it turns. Thursday brought a sharp reversal, and this one was powered by earnings. I'll get to those results shortly, because they're the heart of this week's story. And Friday closed the whole thing firmly higher. All 3 major indexes finished the week up around 1%, with the Nasdaq leading, up closer to 1.6% thanks to that late rebound. The S&P 500 ended near 7490, the Dow around 52,485. That 2-week losing streak snapped. One name that didn't fully join the party? The Russell 2000, the small cap index, which ended the week roughly flat, lagging the rebound in the big caps. So the mood swung from cautiously optimistic to fearful to relieved, all inside 1 week. Now, let's unpack why it moved the way it did. Now, over to the economy, because underneath all that price action, the data was quietly telling its own story, and it's an important one. The headline this week, the economy is cooling on inflation, but it's showing new cracks in growth and in confidence. Let's start with the inflation number, because it's the one the Fed watches most closely, core PCE. It eased to 3.3% year over year in June, and the headline figure fell to 3.7% from 4.1% the month before. On the surface, that's real progress. But here's the catch. A good chunk of that improvement came from a temporary dip in energy prices tied to that brief pause in Middle East tensions. So it's progress, but it's the kind you don't want to lean on too hard, because the energy relief may not stick. At the same time, growth is losing steam. The first estimate of second quarter GDP came in at just 1.5%, cooler than analysts had penciled in. So think about what that combination means. Inflation is easing, but the economic engine is slowing at the same time. That's a genuinely tricky spot for the Fed, because the two problems pull in opposite directions.
On the labor side, things actually held up reasonably well. Weekly jobless claims rose to 197,000. That's an uptick, but it came in less than expected, and it's still sitting near multi-decade lows. What that tells you is the job market is stable, not deteriorating, but it's not gaining fresh momentum either. It's holding its ground. The real soft spot was confidence. The Conference Board's Consumer Confidence Index fell to 90.8, missing forecasts, and that's a third straight monthly decline. The present situation piece of that survey, which measures how people feel about conditions right now, dropped to its lowest since early 2021. When Americans feel worse about jobs and business conditions, that pessimism has a way of showing up later in how much they're willing to spend. Now, it wasn't all one-directional. A separate sentiment survey from the University of Michigan actually ticked up, helped by hopes that gas prices might ease. So the confidence picture is mixed, but the trend on the main gauge is pointing down. And one more piece from that Michigan survey worth flagging, inflation expectations eased slightly to 4.2% for the year ahead. Better, but still historically elevated. The public hasn't fully let go of its inflation war yet.
There was also a quieter data point on labor costs. The Employment Cost Index showed private industry benefit costs decelerating slightly, rising about 0.9% for the quarter. That matters more than it sounds, because the Fed watches wage and benefit growth closely for signs of inflation getting baked in. Steady, rather than accelerating, is what they want to see there, and that's what they got. And weaving through all of it, energy costs. Ongoing tensions in the Middle East kept fuel prices elevated, well above where they sat before, and that fed straight into inflation expectations even as the headline data cooled. That brief midweek pause helped ease some of the pressure, but the disruption to oil flows through the Strait of Hormuz stayed an underlying drag on household budgets and business costs. Put the whole picture together, and you get an economy that's cooling but not collapsing. And that specific mix is exactly what made this week's Fed decision so loaded.
So let's talk about the Fed, because this, more than anything else, was the single biggest driver of the entire week. Here's what happened. The Fed held rates steady, which is precisely what the market expected going in. On paper, that's a non-event, a yawn. But it was everything around that decision that actually lit the fuse. Start with the dissent. 3 regional Fed presidents dissented from the decision. And crucially, all 3 dissented in the same direction, all of them pushing for a quarter-point hike. That is the most prominent same-direction dissent we've seen in years. And it sent a clear message. The hawks inside the Fed, the officials who want higher rates to crush inflation, are getting louder and more organized. That's not something the market can just brush off. Then there was the tone at the top. Fed Chair Kevin Warsh stepped up and said, in plain terms, that a central banker looking at today's steady job market and rising underlying inflation would be more inclined to tighten policy. He said the Fed has no tolerance for inflation. And he made a pointed comment that the bond market was already doing some of the work for the Fed, meaning higher yields were helping cool the economy on their own. The market heard every bit of that, loud and clear. Traders who had been seeing roughly a coin flip chance of a September rate hike suddenly shifted to leaning firmly toward one. That's a real repricing of expectations in a single afternoon, and the bond market reacted immediately. Long-term Treasury yields jumped sharply, climbing to near 2-decade highs, even as short-term yields eased slightly. That split, long-term up, short-term down, is investors betting the Fed will eventually have to tighten to force inflation lower down the road. Bank of America captured the whole muddled mood perfectly, describing the market's reaction to the Fed's mixed signals as doved and confused.
And here's the direct line you need to draw. Those spiking long-term yields are exactly what handed the Dow its worst day in over a year. When yields on safe government bonds jump, stocks, especially expensive, high-growth tech stocks, suddenly look less attractive by comparison. Why take the risk when bonds are paying you more? So money sold out of stocks fast. And the oil spike I'll cover shortly hit the very same day, stacking a fresh inflation worry on top of the rate worry. A perfect storm all on one Wednesday. Quick pause here. If this recap is helping you make sense of the week, dropping a like genuinely helps me keep making these, and it's honestly the single biggest thing that helps the channel grow. And stick around, because there's still a lot ahead. The AI and chip drama that split the market clean in two, crypto's quiet but telling week, and what's coming next that could move everything all over again.
Okay, this is where the week got really interesting, because this was a mega cap earnings week, and the results split the market right down the middle. One camp said, see, AI spending is finally paying off. The other camp said, no, AI spending is becoming a drag on profits. And both camps had a headline earnings report to back them up. Let me walk you through both sides. I'm going to group the big AI and cloud players together because that's where the real story lives this week. Let's start with the clear winner, Amazon. Its stock jumped after hours after AWS, that's Amazon's cloud computing business, posted its fastest growth since 2021, with revenue up 37% to about $42 billion. That is exactly the number nervous investors needed to see, because it said in black and white that the enormous sums being poured into AI infrastructure are actually generating real returns. That's relief, and a big part of what turned the market around later in the week. Microsoft told the same reassuring story. It topped estimates across the board, with its Azure cloud growth accelerating to 43%, and its cloud business crossing $100 billion for the year. On top of that, its stakes in AI companies, including OpenAI and Anthropic, actually added to its profit. So that's a second heavyweight casting a vote for the AI build-out is working, and it's paying its way. And then there's Meta, the cautionary tale, and the single biggest company story of the week. Here's the puzzle. Meta's revenue actually beat expectations, coming in around $60 billion. So why did the stock plunge more than 9% after hours? One word. Profit. Earnings per share came in around $6.18, badly missing the roughly $7.20 that Wall Street was looking for. That's about a 14% miss on the bottom line. And here's the number that really rattled people. Free cash flow collapsed to $784 million, down from more than $8.5 billion a year earlier. The cash the company generates after its spending nearly evaporated. That's the flip side of the AI story in one line. Meta is spending staggering amounts on AI infrastructure, and this quarter it showed up as a direct hit to profitability instead of a payoff, the living example of the exact fear that Amazon and Microsoft had just calmed. Apple landed somewhere in between. It posted record iPhone and Mac sales in what was Tim Cook's final earnings call as CEO. Revenue up 16% to about $109 billion. iPhone sales up nearly 22% to a record, and Mac up close to 29%. By any normal standard, that's a genuinely strong quarter. But the stock reaction was oddly muted. And that happens sometimes. When a great result is already fully expected by the market, it just doesn't move the needle. The good news was already in the price. Out on the edges of the AI trade, the pressure kept building. The so-called neo-cloud names, CoreWeave and Nebius, extended their declines on a very specific fear that their biggest customers, companies like Meta and Alphabet, might just build their own AI cloud capacity instead of renting it from them. That would knock out their whole business model. NVIDIA also stayed under pressure early in the week after a report that it's in talks to backstop roughly $250 billion in financing for an OpenAI-linked data center project. That raised eyebrows about circular financing in the AI world, the worry that the same handful of giant players keep funding each other in a loop. And Intel stayed soft as well, mostly on that general chip sector caution, even without any fresh company-specific news. One more name in the rotation story? Alphabet shares continued to slide this week, caught up in the same nervousness about heavy AI spending and who ultimately profits from it. So there it is. One earnings week, two completely opposite verdicts on the exact same AI story. That tension is the beating heart of this market right now.
All right, let's talk crypto. Though this week, the real story is mostly about what didn't happen. Bitcoin basically went sideways. It held in the low to mid $60,000 for the entire week, unable to build any real momentum in either direction. Ether did much the same thing, hovering near $1,900 without any clear breakout. This was a range-bound, choppy, indecisive week for crypto. Not fearful, not greedy, just kind of stuck in neutral, waiting for a signal. And there were two forces pulling against each other. On the hopeful side, you had the SEC. Its chairman, Paul Atkins, voiced public support for the Clarity Act. That's a piece of crypto-friendly legislation. And that news gave Bitcoin a one-day bounce midweek, helping it reclaim a level it had recently lost. But that lift faded fast, right about the time Fed anxiety took back over the whole market. Good crypto news simply couldn't compete with the Fed.
On the cautious side, the bigger tell was the money flow, because it just isn't flooding in. US spot Bitcoin ETFs are on track for their smallest monthly inflow total on record for the entire month of July. Now, there were small daily inflows scattered here and there. One on Thursday was concentrated almost entirely in a single issuer's fund. But the big picture is one of tepid institutional demand. Ethereum ETFs, meanwhile, swung back and forth between small daily inflows and outflows with no clear trend either way. So the takeaway is simple. Crypto spent this week waiting on the Fed, right alongside everybody else. Now over to commodities, and this week it was all about one thing: oil. Oil was an absolute roller coaster. It fell 3 straight sessions early in the week, while that pause in Middle East tensions was holding and taking some of the risk premium out of the market. Then, midweek, it reversed hard, jumping about 5% in a single session as those regional tensions flared up again. And it wasn't only geopolitics driving it. US supply got noticeably tighter at the same moment. EIA data showed crude inventories fell by roughly 7 million barrels for the week, far more than analysts expected, pushing stockpiles down to their lowest level since 2018. So you had tighter supply colliding with renewed tension in a critical shipping region, the Strait of Hormuz, and the result was a sharp, fast move higher.
And the timing of that spike is the part that really matters. It landed on the exact same day as the Fed decision. So you had a fresh inflation worry from oil hitting at the precise moment investors were already repricing a rate hike. 2 separate inflation fears colliding on one single afternoon. That's a big reason Wednesday was as ugly as it was. Elsewhere in the metals, silver posted a gain for the week, though it eased back a little on the final day. Copper extended its climb, continuing a multi-week rise, but that one moved more on its own supply signals and shifting rate expectations than on any geopolitical story. And natural gas edged higher after a smaller-than-expected storage build. So the pattern was clear. A relatively quiet week across most of the metals and gas, and a very loud headline-grabbing one for oil.
So let's tie the whole week together, because the real story here isn't fear and it isn't greed. It's a tug-of-war. On one side, you had the Fed. Its hawkish hold sent long-term yields soaring, handed the Dow its worst session in over a year, and got a real assist from that midweek oil spike, piling inflation fear right on top of rate fear, all at the very same moment. That was the force yanking the market down. But on the other side, pulling right back up, were the hyperscalers. That very same week, Amazon and Microsoft proved that AI cloud spending is still genuinely paying off, even as Meta showed the painful flip side of that exact same bill. And that reassurance is precisely what dragged the market back from the brink by Friday. So picture it. The Fed pushing rates and yields up on one end of the rope, the cloud giants pulling confidence back on the other. 2 powerful forces, opposite directions, same 5 days. And here's the thing. Neither side actually won this week. That fight doesn't get resolved by anything that already happened. It gets resolved by what comes next. Which brings us to next week. And this is the payoff I promised you at the top. The single biggest event on the calendar. The July jobs report, out Friday, August 7th at 8:30 a.m. Eastern. This is the first full read on the labor market since the Fed's hawkish hold, and it's the one data point that either hardens the case for a September rate hike or unwinds it completely. With early ADP data already hinting at weak private hiring, the fear heading into it is a nasty 1-2 combination. Sticky inflation on one side and a softening job market on the other at the same time. That's the exact mix the Fed has spent the last year trying to avoid. Before that, keep an eye on the Treasury. Its quarterly refunding announcement lands on Monday and again on Wednesday. First the estimate of how much it needs to borrow, then the actual auction sizes. And after this week's sharp spike in long-term yields, the size of that borrowing could push yields around all over again.
And it's another huge week for the AI trade. AMD reports Tuesday after the close. That's a direct read on AI chip demand, with Palantir and Supermicro also on the calendar around the same window. After this week's split verdict between Amazon's strength and Meta's stumble, the market's about to get a fresh batch of evidence on whether the AI build-out is still paying its way. So both of the week's dominant threads, the Fed on one side, the AI trade on the other, hand straight off to next week. And the jobs report is the hinge everything swings on. And don't forget the one thing that matters most in the markets. Prices don't move on what happened. They move on what people expected to happen. And the gap between the two is where the whole week lives. So if this helped you make sense of the week, a like really helps me keep making these. Subscribe and turn on the bell so next week's recap finds you. And drop me a comment. What surprised you the most this week? And where were you off with your expectation? See you next recap.